All right, a very good afternoon, friends, ladies and gentlemen, joining us from across East Africa. Hope you're having yourselves a very lovely afternoon today. On behalf of the East Africa Law Society, I'm really thrilled and delighted to welcome you for this very wonderful and timely session that is discussing tax trends in 2026. In particular, this afternoon, friends, will be looking at navigating change, compliance, and opportunities for East Africa. Now, as you all know, tax systems around the region and globally are going a profound shift, and we're seeing increasingly accelerated reforms, increased digitization of tax administration, and a strong enforcement posture by revenue authorities. At a time, when there's a rise of the digital economy and cross-border business modules, there is a huge challenge that is coming up that is really putting to task traditional approaches to taxation. And as such, this afternoon, we are trying to tackle, or rather to reshape, the tax landscape and try to, bring it more into a complex data-driven and strategy significant landscape. So for our colleagues who are in private practice, those who are in-house counsel, this is the session that you have been waiting for, and it will set a foundation for you to look forward into a lens of tax reforms that are, loading up the impact of digital tax systems and the realities of the digital tax economy. At this juncture, it's my pleasure to introduce our esteemed moderator and friend, Mr. Edwin Mugumya, who is an associate with over 5 years experience across a wide range of practice areas, including litigation, ADR, corporate and commercial transactions, tax compliance, technology, media and telecommunications, amongst other areas. His multidisciplinary expertise positions him well to guide this conversation that sits at the intersection of law, business, and policy. Now, Edwin is a graduate from my alma mater, Makerere University. He's a former president of the Makerere Law Society and the Uganda Law Students Society. He has a strong background in legal scholarship and moot court practice, including the Jessup Moot. Professionally, he's advised and represented multinational clients across the region in key areas such as telecommunications, banking, insurance, energy trade, and he continues to contribute to public service as a youth councillor in Shema district. Talk about diversity. Then I'll bring you Edwin. Now, ladies and gentlemen, Edwin Mugumya brings perspective into discussion, and we may now give him a round of applause as he joins us. Edwin, I'm handing this over to you to introduce our esteemed panel of guests this afternoon. And we have approximately 1 hour and 50 minutes to have this lovely conversation. So I'll hand it over to you, Edwin.
Right. Thank you very much, Gabriel Achaye, for the very kind introduction. Good afternoon, distinguished panelists, colleagues, and participants joining us today from across the region and beyond. I trust we are all fine and are also able to hear. My name is Edwin Mugumya. As introduced, I am an advocate of the High Court. I currently practice with Katende Sempebwa and Company Advocates in Kampala, Uganda. I have the humble privilege of being your moderator for today's session. Today's webinar is on the subject of navigating change, compliance, and opportunities across East Africa, tax policy 2026. The discussion is certainly timely and comes, at a time when East Africa tax landscape is undergoing a period of significant transformation. I understand governments across the region about this time are implementing wide range of reforms aimed at strengthening, domestic revenue mobilization, enhancing compliance, and responding to the ever-evolving global tax environment. And as it is said that from the time Jesus said that give Caesar what belongs to Caesar, the tax regime has from that time gone under different shifts and changes. I understand in our audience we have tax practitioners. I understand we also have colleagues in the business sector and other stakeholders that are interested in the area of taxation. The changes that have happened regarding tax regimes in the region, while they are challenging, they also present important opportunities. On the part of the government, it's an opportunity to build more resilient economies. For the business side, it is to innovate and structure operations more efficiently. And then also for the practitioners to play a part in strategic role in guiding compliance and shaping policy discourse like we are doing today. The discussion certainly comes at a critical time when, as we look towards the forthcoming financial years in the region, the key themes such as digital taxation, VAT reforms, minimum tax regimes, regional harmonization with the East African community continue to take shape in the fiscal outlook of our economies in the region. And as stated, the question therefore is no longer whether change is happening, but rather how effectively we are responding to that change. So to discuss with us the topic today, we have a panel of 4 members. That is Ms. Mbekeka Vanessa Irene Muneza, and Dr. Laila Latif, Mr. Tony Kalunji, and Mr. Joseph Waziri. As the moderator and as the East African Law Society, we certainly look forward to having fruitful engagements with the panelists and with the audience as well. And I encourage all the participants to actively engage with us during the session by sharing your questions, input, and other perspectives. But just before I invite our panelists for the day, allow me just highlight briefly the few housekeeping rules to guide our today's session. For avoidance of doubt, the session is entirely online and it is strictly for 2 hours between 2 p.m. and 4 p.m. And we'll try as much as possible to be mindful of that time. Each panelist will have 15 minutes to make their presentation, and thereafter we shall open the interaction or the discussion to the audience. You can call it Q&A for about 30 minutes. And in that respect, for our esteemed members of the audience, you will have a chance to submit or even ask your questions at the end of the presentation. So you're encouraged to write down the questions, and at the opportune time, you would certainly ask those questions or make that contribution. With that, it is my humble pleasure to invite our dear panelists to introduce themselves before we delve into the discussion. I will start with Vanessa. Hi, Vanessa, if you can hear me, kindly introduce yourself, just the introduction for all the panelists, and then thereafter we shall dive into the discussion. Thank you.
All right, thank you, Edwin. Good afternoon, everyone. All protocol observed. As mentioned, my name is Mbekeka Vanessa Irene Muneza. I'm a senior associate at AF Mpanga Advocates, specifically in the tax department, and I'm honored and privileged to be a part of this discussion. Thank you.
Thank you, Irene. We also have Dr. Laila. If you could kindly give us a brief introduction.
Thank you so much. Hello, everybody. Greetings from Nairobi. My name is Laila Latif. I'm the Chief Executive Officer of Laila Latif and Company Advocates and an academic at the University of Nairobi. I'm also a director of the House of Fiscal Wisdom and the current chair of the Committee on Fiscal Studies, where we do a lot of work around tax policy formation for the digital economy. It's always a pleasure to be here and to engage with you. Thank you.
Thank you very much, Dr. Laila. We are pleased to have you today. Mr. Tony Kalungi, if you could kindly come in and introduce yourself as well.
Yes, greetings to everyone. My name is Tony Kalungi. Substantively, I am the supervisor litigation in Uganda Revenue Authority. I'm also a student of tax and I'm a practitioner, and I'm happy to be here.
Thank you very much, Tony. I see you being economic with your profile. I understand it is much wider than that. Tony is the person, if you have been in the streets of tax litigation and practice, especially in Uganda and in the region, you've certainly crossed.
Edwin, you're muted.
Thank you very much, Tony, for that introduction. We'll go to Mr. Joseph Waziri. Just a brief introduction, and then we'll dive into the discussion.
Good afternoon, everyone. My name is Joseph Waziri from Tanzania. I'm a tax partner from Breakthrough Attorneys, very much involved in tax advisory, tax litigation, and real estate transactions. Thank you.
All right. Thank you very much, our dear panelists. I should confirm to our audience that we have the best selection of the panelists to discuss what the future of taxation and tax policy in the region looks like. We are pleased to have you once again, and to open up this discussion, I would invite Ms. Irene Vanessa to highlight or shed light on the topic for the day. Specifically, what is this regional tax policy? How does it look like? What is it about? What reforms are being in place with respect to the regional tax policy? And what does this mean for the common man and for the practitioner as well? Over to you, Irene.
Thank you, Edwin. Just please confirm that you can see my screen.
I confirm that we can see you.
All right, good afternoon once again. Basically, my presentation will be quite short and sweet. Just covering the regional tax policy outlook. Yeah, we'll look at a few legislative changes and what the impact of these changes across all the responsible stakeholders. So we are seeing that the tax systems across East Africa are undergoing a fundamental shift, yeah? And this shift is toward revenue mobilization and sustainability. And we see the common denominator of this is the rising public debt, the need and pressure to fund public infrastructure, social services, and obviously to fund any foreign debt that we have. So for example, in Uganda, I think our public debt is between 126 to 130 trillion Uganda shillings. So there's a lot of pressure to find ways of servicing this debt and also meeting the needs of the budget domestically through tax collection. I believe Kenya's debt is also equally high. It's about 12.3 trillion the last time I checked. So we see that across, as governments are trying to have these tax policy reforms, the biggest drivers are these four major drivers that I've listed here. And we see that it's the common denominator across the region. Then the second outlook we're looking at is the digitalization of the tax administration. We see that post-COVID-19, yeah, people have realized that so much can happen online. It's not all about physical interactions, and now businesses, there's ease of doing business online. So we have systems like IFRIS, Electronic Fiscal Receipting and Invoicing System in Uganda. It's for VAT purposes, and I believe other countries have the same. Basically, you're able to issue e-invoices, e-receipts, and there's real-time monitoring of these transactions by the revenue authorities. We have the digital tax systems, we have the eTax. eTax, this is Tony's specialty. It's the URL web portal where taxpayers can log in through their TIN and password. They file returns, generate PRNs and etc. And it's also the portal where people file objections, basically where all disputes arise from. Then we also have Kenya has iTax, Tanzania has IDRAS. I don't know if I pronounce it correctly, but yeah, I stand corrected. Then there's ASCUDA, being the major custom system that is applied through the region, yeah, monitoring goods coming into the country and leaving the country, basically imports and exports. Then we see another substantial BEPS action points, yeah? And all this is to try and minimize base erosion and profit shifting. Now, more than ever, countries are more interested in now having a bite to them that has been duly earned in that jurisdiction. Then we also see a continued focus on compliance and enforcement of tax policies and laws. So previously, we've seen that laws have been generated over time, laws have been in place, but compliance, who is enforcing these laws? Yeah, who has been pushing them forward? So we see, for example, here we have different departments. We have in the URA has a litigation department, it has an objections department, large taxpayers, medium taxpayers, you have an oil and gas, you have a international tax department that deals with the transfer pricing. And all this is in a bid to ensure that all the revenue gaps are closed. Yeah. So you find that if the work has been spread out, division of labor and everything, each unit can focus on something. Yeah. So, and all these laws are now being enforced. Unfortunately for our brothers in maybe South Sudan, who are still trying to develop the laws, but all entities and all countries are trying to do that as well. But for theirs having been affected by the war, they are trying to come up with laws and see ways of enforcing them. So I guess it's a work in progress. So currently we're looking at the fiscal priorities. Yeah. The fiscal priorities, we see again the common denominator being revenue mobilization. So how are governments trying to mobilize revenue? They are burdening the tax base. You're seeing that they're trying to formalize and bring people from the informal sector. We find that the informal sector makes a huge percentage of people that are actually not paying taxes. So how has this been done? There's strategies including how the simplified tax regimes, for example, in Uganda, we have the presumptive tax system. How that works is a person who is informal, you'd say, okay, the informal sector, people who are not dealing in the corporate world, maybe not so educated, they're not going to understand issues of now do depreciation, maybe these are liable deductions, read the laws and understand them. So this system has been put in place for a certain turnover. So let's say if there's a business making less than 150 million a year, there's a specific amount that they need to pay and that's it. There's no need to file a return, declare your assets, calculate depreciation, wear and tear. All those things are actually pushed out, and that makes ease of doing business and compliance. It creates compliance by the informal sector as well. We also see that people, let's say, could say, I'm having challenges. How do I get a TIN? Or maybe let me try and escape the process. But effective last year in Uganda, we had an amendment that said now that NIN, which is the National Identification Number, is now going to be considered. It could function as a TIN, basically. So everyone that has a National Identification Number, basically now that's your way, like how you'll be identified for tax purposes as well. Then we're also seeing taxation of the digital economy. Now more than ever as well, countries and governments have realized that there's a lot that's happening in the digital economy. And again, with also the advice and influence from the OECD recommendations, we see that now huge tech giants and online entities are being taxed, Google, Netflix. Currently, we have digital service tax, then there's VAT. So all that now countries are trying to get on board with that. Then efficiency through technology, that's digital transformation. We've discussed that in the previous slide. I won't go too deep into it. But basically how tax administration is being enforced. Through technology, there's a lot that can be covered as compared to manual kind of administration. Then we have a reduction of tax exemptions that shrink the tax base. Yeah. Also, this is also influenced by the global standards. So you have Pillar 2 that has a minimum tax of 15%. Yeah. So you'll see that if a multinational entity has come to, let's say, Uganda, we have tax exemptions that cover strategic businesses. You'll see that if the multinational comes from a country that's enforcing the minimum tax, they would not have paid tax in Uganda, but they'll have to pay it in their home country. And this, in a way, neutralizes the tax incentive. I personally would propose more of a cost-based incentive as compared to profit, exemptions, because now it's creating a clash, with different countries' enforcement practices. So moving on to the legislative trends, So we are seeing, again, across the board, East Africa, let me start with corporate income tax. We are seeing a strict enforcement of the transfer pricing rules, So now more than ever, there's requirements to have transfer pricing policies while you file your tax returns, You need to have a master file, a local file, and all that is now being enforced. Countries have now generated specific legislation to cover transfer pricing and also enforced penalties where entities are actually not complying, because there's a lot of tax that is actually being eroded from the country that should actually be entitled to this tax. Then we also see thin capitalization rules and interest deductibility limits. In Uganda, we moved from the thin capitalization and moved to interest deductibility, so it's 30% EBITDA. And I think that's similar across Uganda and Kenya. Then I believe Tanzania has the thin capitalization rules at a debt to equity ratio of 7:3. So we are seeing that countries are now really legislating these things to minimize loss of revenue, base erosion, and profit shifting from their jurisdictions to other countries. We're also seeing increased audits on multinationals, but also equally locals. Currently, we have an audit can be spanned for a period of the last 5 years. Then we have assessments being raised in 3 years, and the exceptions being fraud, negligence, things of the sort. So we find that revenue authorities are now auditing and trying to ensure that they're not losing revenue from corporate income tax or any other tax heads. We're also seeing digital service tax across the board. Uganda has a digital service tax. I think it's the highest at 5%. There's an exception when you're providing digital services to an associated party, then you go under the withholding tax regime. Kenya has it increased from, I think, 1.5% to 3%. Rwanda is 1.5%. Tanzania is 2%. South Sudan doesn't have this yet. So we are seeing that all the countries across the region are actually moving in the same direction, and there is a lot of similarity. There's someone who said when Kenya coughs, when Kenya sneezes, Uganda catches a cold. So everything that happens maybe in Uganda, it's just a matter of time that it happens in Kenya, or the vice versa. So we are all learning from each other. So we see that. So under value added tax, like I've mentioned, the digital services tax, Uganda is 18%. Kenya, I believe it's 16%. So we find that not only are these multinational entities paying digital service taxes, also VAT, and now there's a requirement for them to actually declare this VAT and taxes. Then we are seeing e-invoicing and stricter input VAT scrutiny, and this is also a reform that's meant to remove people from the informal sector. So, for example, entities are not allowed to expense, or claim a deduction where there's no e-invoices that's supporting it, or an e-receipt, and that has forced people, because they will subsequently run out of business if they actually can't join the movement of IFRIS and e-invoicing. So even when you're claiming input VAT, there's need to see that e-invoice, that e-receipt, and it's monitored in real time. Now, for the excise duty and sector taxes, we are seeing revised frameworks. Governments are targeting telecoms use, looking at mobile money transactions, There's excise duty on that, fintech entities, the betting and gaming entities that are also generating a lot of income, and governments are actually now picking on this. Fuel, then the oil and gas fiscal regimes tightening. We're seeing that some of these policies are no longer as efficient, due to the changing of the change in times and practice and everything. So as we've discussed all this, we now try to think about what are the practical implications of all these trends, all these changes in legislation for the different stakeholders. So we have businesses, how are they being affected? There's increased audits. These audits are quite costly, and there's need to be prepared for these audits. Then we see a higher compliance burden, having to file and prepare transfer pricing policies, having to file your income tax returns and whatever returns you have to file. You see that creates a burden on the businesses, but it's their obligation that they have to do. Real-time visibility. We see that URA now has real-time visibility. Okay, that's Uganda Revenue Authority of the transactions, because let's say a supermarket, as someone brings goods to the till and checks them out, URA has this information in real time. Then there's also a growing need for defensible tax positions. So there's filing, for example, you're saying you're in losses for 1 year, 2 years, 3 years, there's need to actually be able to defend those tax positions. And this goes down to what kind of documentation do you have? Are you maintaining your records properly and things of the sort? Now, the other stakeholder would be the investors. Of course, the investors across the region, Uganda, Kenya, we see that there's now a reduced blanket incentive. There are now reduced blanket incentives. It's no longer just open. For example, I'll say Uganda has strategic investments. You'll find that if you're not falling under those strategic investments that align with the policy priorities, what is the government trying to achieve by providing for these exemptions? So it's no longer just quite open. It's now you have to fit within a box that they have created. And obviously with investors, they also need to have tax certainty. We find that our tax laws are amended quite frequently compared to other legislations every year. And like someone mentioned earlier, that around this time, bills are coming out, discussions have started. So you find that this year an exemption could have existed, and next year it's something else, or a deduction that could have informed the decision of the investor. So investors are affected by this because they need to know, can they make a projection of 5 years and say, in 5 years, will I be able to actually earn this income? Or 2 years down the road, I'll lose this deduction, I'll lose this, and maybe now I have to look at 10 years. So there's also that really affects them. And the need for cross-border structuring of operations. So you'll find that multinational entities operate, maybe Uganda, Mauritius, different entities. So the importance of structuring these operations. What are the tax implications of shared services? How the need to prepare transfer pricing documentation for it to ensure that arm's length prices are charged for these transactions. So all that should be considered and is quite important. Then lastly, for the practitioners, being the majority of people here, we see an increased advisory demand. We find that now so many people are coming in to ask, how should I structure my business? Maybe I have a tax assessment. What should I do about it? What are the taxes that are owed from me to the government, and what are my obligations? So that's an area that we can actually now be open to and say, you know what, as the legislation is changing, as the trends are picking up, there's also need for us to equip ourselves to be able to provide this advice to our clients. Then we're also seeing a rise in disputes. For example, in the first half of the year, being July to December 2025, we saw 199 applications filed in the Tax Appeals Tribunal. And these applications were valued at 394 billion Uganda shillings. So this is a lot of revenue that's also locked up, and government wants to take out this money, but also taxpayers are saying, maybe I don't have to pay this tax. So we see that rise in disputes, which is an opportunity again for the practitioners to actually ably represent their clients. And then also we see that so many organizations are now focusing on tax risk management. They will probably need or seek tax health checks ahead of time. Maybe advise me, look at my previous filings, look at my returns, am I doing okay? What are the risks that I have? And maybe take advantage of the different programs that are available. For example, we have the voluntary disclosure program where you declare and say, you know what, I have done a self-check and reviewed and seen that, I should have paid 10 million as opposed to 5. Here is the 5, yeah. And then the penalties and interest are waived. We're also seeing circumstances where we have waiver of interest and penalties when a person pays the principal tax. Yeah, so all that is happening, and these are the practical implications that we have to take note of. And that brings me to the end of my presentation. Over to you, Edwin. Thank you.
Thank you very much, Vanessa. That I should say that was quite insightful on the subject. We do appreciate the time that you put in to prepare, and also the generosity to share the knowledge with us. You covered quite a number of things, and what stands out for me is where we are going. The fact that, we now find ourselves in this space where, someone can come from every other country and then obtain also revenue from another country. And yet initially the tax laws of this country did not envisage that would happen. I mean, we come from a place where some of tax collection measures included, visiting physical stock, physical premises, make an assessment of how much the person is earning. But here we have digital platforms. Someone from the United States is earning income from Uganda, is earning income from Kenya, and yet they are probably not within the reach of the tax bodies. I want to call Dr. Laila to take it on from there and put us in the direction, or point us the direction of how are the economies ready for this? How should the taxpayers themselves? I understand most recently in East Africa, among many countries have adopted the model of, taxing digital companies that are not necessarily in Africa. And certainly that presents challenges, but then there are also opportunities. So Dr. Laila, I would invite you to discuss with us, how do we navigate this digital economy? How do we go through the digital space? But of course, focusing on these non-residents, and then the tech-driven business models that are sourcing income from economies where they do not have permanent establishments or physical offices. Over to you, Laila.
Thank you so much, Edwin. I think this is going to be such an interesting discussion because it's on the tips of everybody's tongue. How do we collect or how do we maximize a country's approach to DRM by actually getting to tax the digital economy? And the digital economy is just, it's an interesting economy that is continuously emerging. It's innovative, it's creative, and there are lots of different models that keep coming in. There's a lot of money that is being made, but a lot of it is also not being captured in the tax net. So I think before we discuss the taxation of tech-driven business models, which is key to this entire unpacking of navigating the digital business model, I want us to actually understand the business itself. Because what you see on the slide here, in terms of the question it raises, is who creates value in the digital economy, who derives income from it, and who has the right to tax it. And these three questions, they have three legally distinct answers, and obviously they do not align. So now, let's talk about tech-driven business models, because we have to understand the taxonomy if we're going to be thinking about whether we are able to tax this emerging side of the economy and whether the non-residents who are participating in the growing aspect of the digital economy are subject to taxation. So what you see on the left-hand side here we already have the established models. We know that there are e-commerce platforms that are earning commissions. We know that there are streaming services that are earning subscription fees. There are search engines that have monetized user data through advertising. We've got social media selling user attention and cloud providers who are charging for infrastructure. We've got payment platforms that are taking transaction fees. We've got app stores that are taking 15 to 30% of every sale. So the revenue authorities have at least attempted to frame a sort of a legal response to this area here, right? Because we are becoming quite knowledgeable about how this business model operates to generate income and business profits and how we can figure out the tax regime on it. Now, on the right-hand side are what I refer to as the emerging and frontier models. And this is where I want your attention, because these are increasingly where, your clients operate and precisely where the law has not caught up. So when we talk about software as a service, it delivers software through cloud subscriptions. There's no physical product. Ad-driven data extraction, it treats the user's behavioral profile as the revenue generating asset. And then we have AI as a service, which delivers computationally generated outputs through API calls with no human provider on the other side. We've got decentralized finance and crypto exchanges which operate peer-to-peer with no custodian and no withholding agent, Yani. And then we also have the non-fungible token platforms, which are generating real income with no binding tax classifications in any East African community jurisdiction. We have the Internet of Things, which has come up with data monetization, and it crosses 3 different jurisdictions between collection, processing, and sale. We've got the creator economy, which is routing revenue through 3rd jurisdiction platform intermediaries. Now, the income characterization of these new models is the central legal question that we have to ask ourselves. How do we tax these platforms? Now, to be able to answer that question, we have to also understand how tech-driven models generate revenue in the first place. So what you're seeing on the screen is basically the value chain. And if you try and read this diagram from the left to the right, what you're seeing is that we've got value inputs, right? This is the value chain, the value inputs. But who are the value inputs? It's the users, it's the user-generated content, it's transaction data, it's third-party data sets. And they all flow into the platform engine. Now, the engine is where the legal structuring happens. This is where we have intellectual property, algorithms, patents, trademarks, legally domiciled in usually Ireland, right? The Netherlands, Singapore, or even the Cayman Islands. And then we have data infrastructure that is in a third state. And we have a market architecture that creates the network value. So the payment routing is always to a neutral jurisdiction that keeps income away from the market state. So in as much as the users are in Kenya, across East Africa, that are monetizing these digital platforms, helping these digital platforms earn an income, make business profits, we are not seeing that user-generated monetization of these digital platforms in these other countries being taxed by our governments, right? Whether they're being taxed in their jurisdictions is a different question that we have to answer at a later stage. But we have to understand how the model operates so that we know at which point in the value chain is money moving and is that money being subjected to taxation. Then the right column, it maps that engine to the income types that tax law recognizes, right? So our tax law will recognize subscription and software as a service fees, which generate business profits. Advertising and data licensing, these generate business profits, or even royalties if they're, IP derived. We've got API licensing fees that generate royalties under Article 12 of the, OECD DTA and even the UN tax model. We also have transaction fees that generate business profits or service income. So you're beginning to see that, yes, these models that are digital, they are actually generating income and business profits, and there's a way in which their income and their business profits can be taxed on the basis of subscription, on the basis of data licensing, API licensing, transaction fees, right? So what we need to think about then is how do we classify the income that we're beginning to see extrapolate across this digital economy. So the income classification bar that you see at the bottom here of the slide, where we talk about business profits, royalties, dividends, interest, capital gains, service fees. We're all familiar with this because, we tax them with respect to companies that have a permanent establishment or, like you said, Edwin, a physical office somewhere. But the same principle also applies to digital business models because we have to tax them on the basis of their business profits, their royalties, dividends, interest, capital gains, service fees. So each then attracts a different treatment, a different withholding obligation, and a different audit risk, which is what I'm going to discuss next. Because you see, when we're talking about the digital economy, we are not ring fencing it to our domestic system, our domestic tax system. We cannot say that we are going to create a legislation which is going to allow us to tax Google at the level of Kenya, because Google is global, right? It can't be ring fenced. So when we're talking about taxing these digital platforms or these digital tech-driven business models, we have to think about the global implications that allow countries that are market jurisdictions to be able to tax them. And that is where we are actually stuck. So before we talk about where we are stuck, I think income characterization is important to understand, because income characterization is what determines for us what Kenya can tax. How Kenya can tax OpenAI, NVIDIA, Google, Apple, Alibaba, WeChat, right? That is what determines the tax model for us. So characterization then is really not a compliance question. It is a treaty question. It determines which article of the applicable double tax agreement governs whether the source state can levy withholding tax and at what rate. And tech companies invest significant resources in engineering their revenue streams to attract the most favorable characterization. And our job as lawyers is to understand what they're doing and to advise accordingly. So if you look, business profits are taxed under Article 7 of the DTA, right? They're taxable according to the DTA only in the resident state, unless there is a permanent establishment in the source state. If there is no permanent establishment, it means no source state tax. And that is the foundational problem of the digital economy. And it applies to every SaaS subscription, every cloud hosting fee, and marketplace commission that is earned from East African users. When you look at royalties under Article 12 of the DTA, again, it's a bit different. Article 12 says source state, like Kenya, withholding is permitted. But the treaty rates range from 0 all the way up to 15%. And then Article 12B of the UN model, it extends that withholding right to automated digital services without requiring a permanent establishment. So then the central audit battleground becomes reclassification. The tech firms are going to route revenue as services rather than royalties to avoid withholding tax obligations. Now, arguing that what appears to be a service fee is economically a royalty is the primary legal weapon that is available to developing country revenue authorities. Now, for the remaining income types, where you see dividends, interest, capital gains, and technical service fees, 3 points matter practically. Dividend withholding tax under Article 10 is theoretically available to our countries, right? But it is inoperable where there is no local subsidiary. So we can't tax Google if Google does not have a local subsidiary, right, which is resident in our country. When we think about DeFi, decentralized finance protocols, it generate interest equivalent returns with no identifiable withholding agent. So Article 11 of the tax treaty, which allows us to apply withholding tax, in this regard cannot function. And when you think about NFT and crypto asset disposals, these remain unclassified. So we can't even collect capital gains, revenue income, or neither in every East Africa jurisdiction. Now, what makes tech-driven business models non-resident? I think this is the main question. right? Because we're thinking about designing a tax system to navigate the digital economy, which means we need to think about, are they subject to taxation in our jurisdiction? So that's the question. What makes these tech-driven business models non-resident? And being non-resident doesn't mean you're not subject to taxation. Being non-resident means if the nexus rule applies to your jurisdiction, you're able to tax. But there are 6 structural features of digital non-residents. And I want to be explicit that these are design choices. They're not really accidents. So when we talk about asset-light operations, now these require no physical infrastructure in the market state. So intellectual property is legally domiciled in a low-tax jurisdiction, usually Ireland, Singapore, Cayman, and the services are delivered remotely. So no employee or server needs to be present in the customer's jurisdiction. When we talk about cloud infrastructure, it sits in a third state which is separate from both the company and the customer. So the payment routing keeps revenue out of the market state. And the corporate structures within this tech-driven business models are deliberately fragmented. You'll have holding companies, IP subsidiaries, and operating entities that are split across multiple jurisdictions, and then each is taxed in isolation. So the result is then set out on the right. Yeah? The revenue accrues in the market state, but the company is legally not resident there because no permanent establishment is triggered, which means then royalties are going to flow to a low-tax IP holding entity, and the profits are going to be booked in the resident state. So East Africa, we bear the cost of providing the user base, but we collect no corporate income tax. And I'll be precise about this, yeah, because this is not tax evasion. It is the legal exploitation of rules that were designed before the digital economy existed. And that distinction matters for us because the solution then is legal reform, not really prosecution. Then comes the question, right? We're talking about navigating the digital economy. We're talking about the taxation of non-residents and tech-driven business models. But then the jurisdictional question emerges. Who gets to tax? So here we basically have 3 competing claims. The resident state holds full corporate tax rights under the current treaty rules, but it is usually typically a low tax jurisdiction that benefits from the digital economy without bearing any of its infrastructure costs. The source state has withholding rights on royalties, dividends, interest, and even service fees under Articles 10, 11, and 12, but source is increasingly difficult to establish when payment routing through neutral jurisdictions deliberately, obscures the answer. So the market state, which is East Africa, is where value is usually created, where users provide data, attention, market access, and where significant economic presence rules, digital service taxes assert taxing rights, but it is the weakest claim under existing treaty law and the most economically justified one, right? So you get to see Africa's position, which is in the gold banner at the bottom. It's about source and market taxation primacy, tax where value is created. Therefore, we have started developing the significant economic presence rules like in Kenya and Nigeria. Certain countries like Rwanda and previously Kenya, we had the 1.5% digital service tax, and then we apply Article 12B of the UN model on the tax treaty to allow us to be able to tax some of these digital platforms, even though they do not have a physical presence in our country. So these are instruments of that principle. Now, it's important to also understand what the rules say, because like I said, when we're talking about taxing the digital economy, it's not a domestic state affair. It's a global issue, and we have to have global rules around this. So there are 4 rows that you see, and you should probably, when you get the slides, you can read them in chronological order. Row 1 is the permanent establishment doctrine. I think that's the most important doctrine. It's what establishes the nexus. It's what gives national governments, domestic states, the jurisdiction to be able to tax digital business models. If we can't establish PE, there is no way in which we can tax. So then the conversation shifted to the OECD Base Erosion Profit Shifting Program, and they started thinking about what do we do in order to be able to tax the digital economy, because it's $1 trillion industry. I mean, data monetization is already hit $1 trillion, but no state is seeing the revenue. What do we do? So the OECD came up with a two-pillar solution. Pillar one is about relocating taxing rights to market states. So Google, if you're generating profits out of Kenya, you have to start reporting on a country-by-country basis using common reporting standards to be able to inform Kenya Revenue Authority the proportion of profits that were made out of Kenyan users, and then allow KRA to be able to tax that proportion. That was the discussion under Pillar 1, but Pillar 1 has stalled. We're not moving any further with it. So what has happened? So then, because Pillar 1 stalled, countries came in to be able to now take up unilateral measures. And that's where you saw Kenya take the lead in introducing the digital service tax. And we collected substantially a lot of money by introducing the 1.5%, which we now repealed, and we have replaced with the significant economic presence rule at about 3%, right? And then we also have the fourth approach, which is the UN pathway. That's Article 12B, the source state withholding tax on automated digital services without PE. Now, the problem is the UN article helps us to tax automated digital services, e-commerce, etc. But what about data monetization models? What about artificial intelligence as a software? This is not being captured, and this is where the money is. So non-residents forget about taxing them on the basis of these new emerging trends within the technology-driven business models. So finally, before I conclude, I wanted to speak a little bit about the East African regional response. But Irene, who went before me, I think she already tackled that by presenting a sort of a mapping about where African countries are and East African countries are in terms of taxing these digital business models. And we've already talked about Kenya. Rwanda has a 1.5% DST that targets advertising, search, and subscription platforms, which is activating in 2026, but it has regulations that are still pending. I think Ethiopia's income tax on digital providers, it has been established since September 2025, with digital income reclassified as Ethiopian source income. So we're beginning to see countries really take keen interest on wanting to tax these particular platforms. Now, as lawyers, finally, it's really important to think about compliance and risk management. If your clients are this non-resident individuals who are shareholders, owners, proprietors of these tech-driven business models, we have to think about risk management and whether they are complying with not only the global rules, but also local rules. And I think what is really important is to map your nexus to be able to understand, right? Where is the user location? User location is usually the taxable nexus across East Africa. And for you to be able to get that data, we need to also implement at the domestic level, country-by-country rules, country-by-country reporting rules, and the common reporting standards, because this feeds across cross-border income flow data all the way to the revenue authorities. And then you also, like the Nigerian approach, is to ensure that some of these companies that are able to penetrate the African market to provide digital services, they actually register as local subsidiary. And that's the Nigerian approach, and it has really proven fruitful for them. So a seller, for example, who has not registered is not invisible under the DAC 7, which is an EU directive. The EU directive requires digital platform operators to automatically report to the revenue authorities any seller who has earned an income online. And if we can have those similar measures at the East Africa level harmonized, we would be able to look to how we can now, in a coordinated fashion, be able to tax these tech-driven business models. I think, again, the other steps are more about have the legal framework in place and then have the regulatory framework in place that would allow you to now start taxing these non-residents going forward. So I'm going to share the slide with you that you're able to read. The compliance and the risk management model that is really important to be able to also advise your clients on where we are going in this conversation around taxing the digital economy. I'm going to stop here because I think I've gone over time. Sorry. Thank you.
Thank you very much, Dr. Laila. We sincerely appreciate the presentation that you made or navigating the digital economy. I have 3 areas where I request you to kindly shed more light with the audience. Number 1, we have, as you stated, all these companies coming into our economies in East Africa. Google, Apple, Amazon, etc., mention it all. Some of these companies, they are operating at a portfolio that is way higher than some of the economies. How do we, our economies or tax bodies in position to actually enforce revenue collection from some of these tech giants? And number 2, yes, they are coming into the economies, and we understand there are so many people, especially the young people, that are leveraging on, most especially the technology that is being provided by these companies. How do we strike a balance between government maximizing revenue collection from these companies, but at the same time ensuring that, the young people that are depending on this internet do not end up having to bear the tax burden? Because the knee-jerk reaction for a taxpayer is that if the tax body imposes, a tax on me, then I'll transfer that tax burden to the taxpayer. So how do we do this balance? On the one hand, we are collecting revenue as the economy. On the other hand, we are ensuring that our people are not prejudiced, or that the burden does not end up affecting them. Then lastly, for your clarification, from a fiscal policy perspective, no one enjoys paying tax, that we agree. And we have, these tech giants which actually feel that they're doing us a favor by operating in our country in the first place. And some of them, I have seen, comments of, they are, in their view, they're not collecting so much from our economies compared to, what they are collecting elsewhere. How do we ensure that, on the one hand, we are collecting revenue from these companies, but also not discouraging foreign direct investment that comes in with, these tech giants? If you can take about 3 to 4 minutes to respond to those inquiries, and then we can move on to the next speaker.
Okay, yeah, thank you, my dear. I think those are really important questions. I'll do my best to keep them within 3 minutes. On your question around how do we enforce revenue collection from these digital giants, right? I think the most important way in terms of designing the fiscal policy is to have withholding at source, because this is the most administratively effective tool for developing countries, where a resident payer, even if it's a local advertiser, a bank processing a payment, a financial institution, is identifiable if we impose a final withholding tax on the gross payment before it leaves the jurisdiction. That's the best way in which we can actually get this enforced. And if you see, there are discussions happening at the UN where we're trying to get away from the OECD model and implement the UN Framework Convention on International Tax Cooperation. When you look at the conversation that the Africans are pushing, they're basically talking about withhold at source and withhold on the basis of gross payment, because that's where you can actually have the highest number of enforceability. Then the other conversation is about platform blocking, because Kenya has given KRA the power to direct the Communications Authority to block access to a non-compliant platform services for Kenyan users entirely. So that is a market access threat that tech giants actually take seriously. Losing a market is a commercial consequence that no amount of legal structuring is going to insulate against it. So regulators in Indonesia have done this, in India they've also done this. So I think those are the 2 points I'm going to give you quickly. And then I think this part about maximizing government revenue collection and then ensuring that young people don't end up taking the tax burden. I hear you. I think the tension in this is real, and it's not just political. It has a legal and it has an economic structure that is worth being precise about. But first of all, you have to think about the double taxation problem that is inherent in this particular question you've posed for me. If you have a non-resident providing digital services into Kenya, Kenya, who's currently facing the significant economic presence tax at 3% of gross turnover, 16% VAT collected from customers, potential withholding tax on any intra-group payments, and corporate income tax in its resident state. If the resident state does not give a credit for SEPT, and many do not, because SEPT is not a conventional income tax, then the company ends up paying twice on the same economic activity. So the gross basis taxes actually compound this. They apply regardless of whether the business is profitable or not. So where you have a loss-making market entry phase, which is taxed as the same as a mature, highly profitable one, that then becomes a genuine barrier to investment and to the smaller digital businesses that cannot absorb this compliant cost the way in which Google would be able to. So I think also when you look at Kenya's removal of the 5 million threshold, it actually means that a freelance developer in Berlin, Germany, who's selling software tool to a single Kenyan client owes SEPT from the first dollar. The compliance infrastructure which is required is that KRA will call for their registration, their monthly filing, the foreign currency remittance, which is the same for that as an individual for Netflix. So then the tension here is that the administrative cost of compliance may actually exceed the actual tax liability. And that then becomes bad policy and it undermines the legitimacy of the regime. So that's what the state needs to think about. Do we need to maximize revenue collection, or is that going to impose a huge burden on young entrepreneurs or even the startups? That shouldn't be the main question. The main question should be, where is the administrative difficulty and where is the administrative cost of compliance going to be? Because at the end of the day, we're struggling with debt distress. We're struggling with austerity. There are floods. The infrastructure is becoming a problem. We need the money. And if we start having this discussion about it's going to be a tax burden, it's against the AU Agenda 2063. It's against the Seville commitments for FFD4 that we are all talking about broadening our DRM space. And then lastly, I think Irene had talked about this, right? When she mentioned about Pillar 2. And she said something on her slide that even if we decide to provide a tax incentive, right? Because the government can decide to say, come and invest in our country as a way to lure for FDI on the grounds of we will give you research and development incentives for the first 10 or 15 years. That's a tax incentive. But under Pillar 2, if we choose to give them a tax incentive as part of the income inclusion rules under Pillar 2, their resident country would still be able to tax them. So why should we lose out on that particular revenue? That would be my throwback to you, dear.
Indeed. Thank you very much. Well articulated, I should say. And so that was quite precise, on point, and well put together. Thank you very much, Dr. Laila. And now I want to take it on from there and invite Tony Kalunji to give us, tax administration and compliance perspectives of this whole aspect of digitization of the economy. Of course, on the one hand, we have, the taxpayers expressing their concerns here and there, but I understand also tax administration bodies have concerns too. So allow me invite Tony Kalunji, acting head of appeals and litigation at URA, to come and talk to us regarding this subject of digitization of the tax administration. What opportunities and challenges do we face, from a compliance perspective?
Yeah, thank you so much, Edwin, for that. I guess after Dr. Laila's presentation, the question is that how prepared are the tax administrations? And the simplistic answer, which can be seen with the ongoing debate, is that even the developed economies have failed to try to tackle the digital economy. If you look at the BEPS, by identifying the action point 1 to be how do we tax the digital economy, if you look at how all that accelerated into Pillar 1, that's sold, and then Pillar 2, we are trying to catch up. And even if you go deeper in Pillar 2, Dr. Laila was discussing, you realize that still the approach in actually Pillar 2 was actually acknowledging a failure in itself. Because you can't tell me that when you're looking for methodology to allocate which country will tax the UTPR, that you have to look at payrolls and tangible assets, and you ignore the intangible assets, and you ignore the digital economy, you acknowledge. But still, there are tools that are existing that we hope you can be able to use to tax the digital economy. So how are we digitalized? So basically, Vanessa had discussed the landscape, and I won't repeat that when it comes to East Africa, but I'll focus on Uganda, the tools we have. So the first one we have is eTax. As we started from graduated tax, at least now there's a system, irrespective of where you're located, you did not have a physical location, but eTax is that interface which we'll look at that taxpayers use. We'll have, when it comes to recording, the IFRS, then we'll have ASCUDA for customs and the BIMS, and then we'll get to see other terms to track the goods of the digital tracking solution where we'll see the stamps. So deeply, eTax, what is it? So the tax administration thought, and we're like, okay, everything that is being done to report taxes, being that we're in a self-assessing system, is manual. Previously, if you wanted to report those taxes, to file a return, to register, you came physical, there was a lot of documentation. But at least this platform came up, and when it comes to registration and at least even deactivation, everything in between, there is a system that at least starts the process and you support it. So everything, at least in eTax, tries to capture on the side of the taxpayer. Now, us internally, it is deeper for the tax administrations. Internally, we can use it to know. I can sit on my laptop and I access a record of the taxpayer, see all their history, see who is currently auditing them, see where the issues are, see whether there is any assessment and everything that has been done. Then we go to beyond this IFRS. So basically, when it comes to receipts and invoices, the procedure prior to this was also physical, hard paper. But now we have what we call e-receipts and e-invoices. So think of a system that every receipt you issue, if you're dealing in goods and services, it is in real time URA is able to see and capture that sale that you've made. So essentially that is IFRS. But to go a step further, it is now mandatory. And it's not only mandatory, there are penalties for failure to issue that e-receipt. You come to customs bit, ASCUDA, of course, developing from ASCUDA++, now ASCUDA World. Now, when the system of importing and exporting, at least there is a system that is in place. Even if you're importing or bringing something in, you can sit somewhere and be able to attach an entry. We look at the documentation and we base on the documentation generally to allow you, except if we need to verify. So at least for customs bit, we are using that tool. Now we have what we call the digital tracking solutions. Now, essentially it's managed by two entities, Uganda Revenue Authority, but in Uganda we have what we call the Uganda National Bureau of Standards. It verifies that the goods that come into the country are fit for purpose, that they meet the standards of certification. So they came up with what we call the digital tracking solutions, but essentially these are digital tax stamps. So every good that is imported or that is manufactured, there is a stamp that is on it. And that stamp is used first by URA to track how many stamps are issued, should be able to correlate with the number of sales. Then also to track the quality, UNBS uses it. And just like with IFRS, it is mandatory, and failure to do that is punishable as an offense. Now we have still customs, what we call the storage of goods. There's a system of bonded warehouse information management systems to try to manage that cargo, because we had issues of smuggling. So we need to know the goods that are imported, how are they managed? If a truck enters Kenya, and it's destined to Uganda, will it disappear in thin air? If it's stored under warehousing system, will it remain there? So we have BIMS that is used by customs. Now, basically the benefits for these systems as they are is that we are able to collect more taxes as revenue administration board. Now, the empirical data shows that before these systems came into play, we were collecting less, but now we are collecting more. And one of the reasons why we are collecting more can be attributed to these specific tools. If we are able in real time to see the receipt you have issued, if we are able in real time to know what you have imported, then we can easily be able to audit and put you to prove. Then also the taxpayers, their compliance has improved. Actually, right now, when it comes to filing a return, before you even file, you know with IFRS. Now, when it comes to tax heads like value-added tax, it is so easy with the IFRS filings for you to file your return and then comply, because the cells must be able to correlate unless you can explain. Then the records are now digital. You no longer need to employ a lot of storage services because the system can be able to store all this info. Then, of course, there are but there are benefits that are not easily seen, but more preventive. We had issues of smuggling. Right now, I think it's a bit hard. They are tracking, the goods are being tracked. It's hard to smuggle. Then when it comes to verification of payments, previously I recall when it came to value-added tax and the taxpayer was claiming import, the requirement used to be that you bring all your invoices, we go through them, then the invoice has to be in a prescribed form, we verify it, we write to the person we dealt with. But right now with IFRS, the verification process is easier. Yes. So costs. Of course, this is two ways, but previously we have downsized. We need not employ a lot of manpower to be able to, first of all, go into the process of registration. We have digitalized, you can sit everywhere you want, you register. Then when it comes to compliance, at all these levels, our staff numbers are reducing because of the technology that is there. Yes, then we'll have mechanisms of dispute resolutions. Now, the way disputes are resolved also has an appreciation when it comes to digitalization. You can basically object online and they can be able to conduct a hearing and give you an objection decision on the online system without you physically coming. So basically, that's the benefit. The rest are instant registration and so on. But of course, the challenges are still there. Now we have to appreciate that we are a developing country, and it's painful really to put these challenges, but that's the reality. We have challenges of limited internet access. The internet now, incidentally, is too expensive in Uganda. On one hand, in our aim to try to get revenue, we tax telecom companies for providing internet. Yet it's the same internet that we hope to use as a tool to tax. So the question would be, if internet was free, would there be more tax compliance? But we hope we tax it. In fact, we used to tax it so much that we had social media tax, OTT, but we later on scrapped. So with limited internet access, taxpayers can validly argue that the services of URA cannot reach outside where they outside towns and where the masts are. Then costs. Taxpayers have raised valid concerns that for them, it is a cost to have to buy these computers. That's a valid point and we need to acknowledge it because we are a developing country. Then we have a large informal sector still. Now, when you come to implement these digital tools to them, for instance, I'll give you an example. It's possible to have a large-scale farmer being a large taxpayer with a lot of revenue, but that business, the way they started it historically, they are not so developed even their location. But now you to come and require them to have these tools in place is a problem for them. For instance, when we introduced IFRIS, we saw cases come up. I think it started with the supermarkets. The supermarkets first took URA to court, saying that why did we target among all businesses, supermarkets, to be the first ones to employ IFRIS? And one of their arguments was that it was a cost to them. But of course, we acknowledge that, and from a policy perspective, engagements were made to see how to acknowledge this. Then, of course, lack of sensitization coupled with limited tax knowledge. People are still not able to understand what this IFRIS is. For instance, it used to be a joke that people used to think that IFRIS is a tax. And last year, the business community striked. They closed shops in Uganda, saying that this IFRIS is a new tax. So it took sensitization to come to tell the taxpayers that IFRIS, no, is an electronic physical receipting and invoicing system that requires you to have your invoices in a digital way, but they were thinking it is a tax for value-added tax. So the lack of sensitization and the limited tax knowledge was what was identified in that issue. Then, of course, coupled with resistance. Resistance was aggressive. Taxpayers still resist to use these tools. So those are the challenges we face as an authority, but still there are solutions. Now, the e-tax that we talked about, it's going to be removed. We are going to have e-tax 2. e-tax 2 will try to address all these challenges, because the e-tax 1 was built to manage basically brick and mortar. But we are not going to try to incorporate other businesses, especially those that Dr. Laila talked about, to see they can also be incorporated into this. Then we are going to use the tools that are available. For instance, when it comes to development of, everyone uses a mobile phone. Why isn't it that someone can use their phone, even if it's not a smartphone, to be able to pay tax or file a return? There are SSD codes. Probably if I get my phone and I use *100#, on that menu that comes up, am I able to see that there is a thing of URA, file a return, put in a tin? So that's what we are aiming at going. Then we are going to get a single identifier. The law has been passed and the implementation is starting. For instance, in Uganda, when you have a national ID, you have a passport, you have a social security card, you have a driver's license, you also have a tax identification number. So the idea is that why can't we have one unique identifier to be on a passport, on every document, and this will help. Because if I get that one number, I'm able to link all the other admins, all the other bodies, and I'm able to get all the information. So that's where we see it will solve everything. Then, of course, we need to develop a unified application. We're going to, because if people are able to develop applications to solve problems in medicine, the law, why is it that we can't also develop what I would call an app to solve all of this? So that's where we are going. And then, of course, but we have to be conversant. There are data protection issues with this information that is coming into play. Are you able to protect the data? The first problem is competitors. Businesses thrive on competitive advantage, secrecy, and also intellectual property. For instance, if you look at, there is a 2019 report of the US. It's a special report of their Office of the US Representative. Now, in that report, and it's what led eventually to the side by side. So the US started complaining that certain, okay, let me first go back. If you look at most of the MNEs, if you go to their beneficial ownership, they will either be resident in the US or the EU, but they are essentially the top. It all goes back to the US. They are the US companies. So the challenge they were putting across were that developing countries And especially if you look at those ones that are not fully developed, like the China and India, that they are not protecting data and intellectual property when they are administering their governments and revenue. So because of that, they were able to complain, and they say, if these revenue bodies are not able to protect data of this country, not able to protect data for these MNEs, it poses a problem to them. So downscaling in that's where we'll have certain laws. And coming back to Uganda, in our laws, you have provisions of you have to protect the data. So in going this for digitalization, this is something we have to identify and try to capture into it to avoid hacking, to make sure that we don't share the data and so on. So basically that is it. The trends have been basically discussed, but essentially we hope to amend the law and have our digitalization fit within the coming digital economy. Basically have one unique identifier, remove this e-tax, make a new one, incorporate businesses that are beyond brick and mortar, have these other businesses that are registered by these other entities like URSB or UNBS also report to URA. And then there's nothing that prevents us in using AI, although in a cautionary manner. If you have a lot of data and you train AI, we need not go through that hard process of doing audits. If we train it so well and they move their talks within that, we should be able to file, and AI is able to generate at least a tentative return or a tentative audit. So the conclusion, basically digitalization is transformative and we are on our way. It benefits tax administrations to develop or improve digitalization because we are able to collect more revenue. There will be better compliance and opportunities for everyone. Then the 2026, what we are looking at, we are going to engage into AI and analytics. For instance, and these are, I think 5 years back, the departments of URA didn't include departments like, now we have a department of IT as a specific department. Now we have another department of risk and strategy. So all these, we are trying to show that if you focus on digitalization and these departments help us analyze and feed information to us, we are able to collect more tax. Then we'll also look at a full digital economy capture. Maybe we'll try to feed off the pillar 2 and just try to incorporate. I don't know whether we'll drop our unilateral measures, but we'll try to see whether it's a way forward. Then also regional harmonization. Now, when it comes to customs, if you look at the East African Community Customs Management Act, ASCUDA, it's as if customs, the harmonization is already there for on international level and the regional level. But when it comes to domestic taxes, there is fragmentation. We have the same goal of taxing the digital economy. We all set out to tax it, but you find that we have different measures, different unilateral measures. Is it possible that we can be, for instance, like the EU as a bloc? Because the EU as a bloc will probably have one unilateral measure to tax the digital economy. Yet here you will have Uganda doing this DSST, Kenya will have this. It's the same, but why can't we also try to pick a leaf from customs? It could be that customs is easy and international, but we can pick the aspect of harmonization and try to look into that. So the call for action would be for everyone to try to be open to change in digitalization by improving, and then also to call on the taxpayers to embrace themselves with what is coming. Yes, so that's that from me. Thank you. Over to you. Thank you. Edwin, over to you.
Yeah, thank you very much, Tony, for giving us insights from the perspective of a tax administrator. There was previously an impression that, the tax administrators were always playing catch up, in that, the taxpayers were moving ahead, or even the digital economy was moving ahead, and then the tax bodies were just following. But from your presentation, it is clear that the tax bodies are actually doing a good job in catching up with this digital economy. Thank you very much. Now, there are a couple of questions that do arise from, that presentation, but I'll reserve them for the audience. Just a polite reminder to our audience, in case you have any questions, do keep them. And then once we open up the floor for Q&A, you would have the platform, to send them through. And then our esteemed panelists will ably respond. I want us to take it on from there. Of course, Tony talked more about, compliance, tax administration. There is a famous saying that, as man has learned to shoot without missing, so birds have learned to fly without perching. It's a popular one. From what Tony presents, it's clear that the tax bodies are not about rest. Yeah, they have to maximize revenue collection. But then there are these struggling businesses. Someone just opened up their online platform. They haven't even, earned that much. And URA is saying, look, you have to pay your fair share of the tax. So I want to bring in Mr. Joseph Waziri to give us perspectives, specifically under the topic strategic compliance and risk management for businesses in 2026. And for the part of our audience that are into business, this is a good opportunity for us to learn that now that the tax bodies are moving into this direction, what strategies can we, adopt, number one, to mitigate risks that may arise potentially from non-compliance, but also to ensure that we keep afloat, we make profit, and we are not killed off by these aggressive and tech-sensitive tax administration tools. So I'll invite you, Mr. Joseph Waziri, to take it on from there. Thank you.
Thank you. Thank you. Thank you, Dean. I believe you can see my slides well.
Yeah, sure, we can see.
Okay. So some of the points that I'm going to discuss, they have already been shared by other colleagues. So I'm not going to repeat them. For example, I wanted to talk about some of the tax enforcement landscape that has been happening in East Africa. Irene has already covered that, all the digital systems. So basically, this first slide, I'm not going to talk about it. The only thing that I will mention here is, as taxpayers, as in-house counsel, it's very important to advise the businesses to make sure that the systems in-house, they are actually very accurate, they work very efficiently, because the Revenue Authority, as most revenue authorities in East Africa, they are already integrating different systems. Now they're even connecting to your mobile money data. So there are businesses that, you have different shops, maybe it's a supermarket or it's a petrol station, maybe it's a whatever kind of business you have, the different payment channels are already now being integrated into the systems. So basically, in-house, the data must be really accurate, the systems must be working very efficiently, because the authorities and the government, they are now busy building systems that integrate the banks, the different government, the agencies, and the municipalities. For example, earlier someone also mentioned about IDRAS in Tanzania. The system, this is a super system that connects all the government systems. There are different phases at the moment, but once all the phases have been completed, like all the systems will be connected, from when you are registering your identification card, your business license, your TIN, your company incorporation, your bank, your mobile money, everything. You want to be more like in advanced countries. So it's very important as in-house counsels and taxpayers also to make sure that in-house we are also working on our systems to make sure that they communicate and information flows well and it is correct and efficiently in order to improve compliance, because the governments are busy, the revenue authorities are busy working on the system, but they also, as businesses, it's important for us to make sure that our systems are also integrating internally and the data is correctly captured and disclosed to different authorities and different stakeholders. So this has already been repeated. I'm not going to repeat that. And how does a strong corporate governance support effective tax oversight? One of the things that can be done by businesses is really to integrate tax into business risk management. Tax is no longer something that can be ignored. Things have changed. There's a lot of scrutiny of taxation, and therefore, when you are looking at the business risk management, tax must be one of the key components that is being monitored, is being managed. And this starts from the board level. Of course, through the audit and risk committee, tax exposures must be properly communicated, must be properly monitored. The management must be able to present to the board so as the board can have an oversight and making sure that the company is compliant. And if there are exposures, what are the strategies to reduce the exposures, the current exposures and future exposures? And some of the exposures, for example, there could be things that are recurring. So as a business, you must come up with solutions and say, the revenue authorities have been coming and audit our company for this year, and they always come with these things. How do you correct that? Do you change your pricing model? Do you change your business model? What do you do? Do you go and do out-of-court mediation? We're going to see some of these things in the next slide. And also another thing to do is to define the tax accountable personnel. It's very important to have a strong in-house, tax and accountants in-house. Do not just depend on the external advisors, because usually tax risk arise from they are able now to work with the rest of the staff to make sure that tax is managed on day-to-day basis, because you are a consultant, your tax lawyer cannot be with you every day. So it's very important to make sure that the team inside is actually intact. I used to work for a company where we used to have, I was the head of tax, and then I have 3 people reporting to me, 2 managers, 1 senior analyst. Someone can say, why do you have to have 3 tax people, 4 tax people, 3 senior tax people in the same company? It was because it is one of the industries that is highly taxed and highly regulated in Tanzania. So basically, even the exposures, they are millions of dollars. So you have to make sure that to manage all these exposures, you have a team of people who on day-to-day basis, they work with the businesses to make sure that transactions are correctly captured, documentation is correctly done, and operations are done in a manner that reduces or eliminates the enhanced audit-ready systems. You have to make sure that, so even as external advisors, when we advise clients, when we go to them, we have to talk about these things. We have to ask them, how ready are you when the revenue authority comes? How correct are your systems? How strong are your internal controls? How is the approval process inside the company? How do you keep your documentation? How strong is your in-house tax team? How do you use technology? To what extent is your technology? For example, nowadays, like in Tanzania, in Kenya, and other countries, and even I heard in Uganda, when our colleague here was sharing, that the invoices are issued through the system. So whenever nowadays you make a sale, the government and through the revenue authority has already captured that there's a particular company that has already sold. So because the systems are now integrated, we have to make sure that everything that we do is correctly done. If there is an error, we report it on time and we rectify it on time. We do reconciliations regularly, because when the revenue authority comes to an audit, they will normally do reconciliations. So if you have reconciliations that are ready, it becomes much easier to address some of the queries that are going to be raised during the audit by the revenue authority. So now what are the strategies for businesses to manage the tax risk in an enforcement-driven environment? Things like internal audits are very important. Most internal audits are done to check controls and the other operational issues, but it's important now to have an element of taxation embedded in those audits. And also, we have to test the tax internal control systems. We have to make sure that the in-house, the different employees, they know what they're doing. If an account payable makes a payment, we have to make sure they know that whether that payment is subject to withholding tax or it is not. And if we are not able to sort of making sure that we control the human error, then at least the system should be able to pick up for this nature of service, the withholding tax rate is this much, you know, whether it's a payment to a non-resident or it's a local payment, the system is supposed to be able to categorize and state that these particular transactions, withholding tax rate is this one. That one helps to minimize the tax risk and the errors. And also we have to do real-time reconciliations and ledger matching. It's very important to reconcile the revenue, the turnover, the expenses, the purchases, and making sure that they speak to different systems. If, for example, you are doing a lot of importation, you have to make sure that when you do your reconciliations, the number that shows the amount of importation, it also reconciles to the Escuda system or to the TANSI system or to whatever custom systems that is in your country. And also, of course, Irene spoke earlier about the related party transaction and the importance of having transfer pricing documentation. This is very important. And even if you don't meet the threshold, maybe for mandatory preparation of transfer pricing documentation, you can just have a documentation prepared for yourself, because sometimes the revenue authority will come and audit you. For transfer pricing, and it may take longer than the time that is provided. We have a documentation that was a company to, and it's important also to conduct health check, tax health check, maybe twice every other year or after 3 years, depending on the risk of your company and risk of your industry. Because from a tax perspective, not all the industries have the same risk. Some industries are more scrutinized by the revenue authorities, some are not. So in case your industry is regularly scrutinized, probably you might need to do more regular health checks compared to an industry that is not really scrutinized much by the revenue authority. And also, you have to make sure that when you file returns, you make payments, you do them timely. This helps to avoid the penalties and the interest that is normally imposed by the revenue authority. And another important factor when you talk about enforcement in the tax environment is dispute resolution. How do you reuse and solve tax disputes, you know, in businesses? One of the things that's to do, and very proactively, is to seek for advanced clarification from the revenue authority. This is a tax ruling. You can seek for a ruling as a business, or you can do a class ruling, which covers a particular industry, if that particular matter is common to your industry. So this is very important because it sort of provides certainty on how that particular transaction is treated in future. When the revenue authority comes to audit you, you can show, you know, I'd already confirmed the tax position, the tax treatment of this particular transaction is like this. So it does help to protect your company from additional tax exposures. And also when you draft different commercial contracts, it's very important to check the tax clauses. You know, some jurisdictions don't allow net of tax contract. You cannot put an amount or a consideration in a contract that is a net amount, you know, because whenever you claim that as an expense, the revenue authority will not allow you to claim the additional tax as part of the expense. So it's always good to do gross of tax contracts. And also some jurisdictions like Kenya, they allow you to have advanced pricing agreements for multinational transaction. This is very important because it helps you to protect your company and reduce the transfer pricing exposure and make sure that you have already agreed in advance with the revenue authority on how you're going to treat some of the transactions between the related parties. So for Tanzania, that advanced pricing agreement yet. In other countries, this is still as we are building international tax and transfer pricing professional in practice in our jurisdictions. And something else that is important in terms of dispute resolution, you know, a dispute happens as a result of an audit. The first thing that happens is a tax audit. So whenever you are audited by the revenue authority, or whenever we are helping businesses during the audits, during the tax audits, we have to make sure they support, they provide all the information during the audit stage, because some of the jurisdictions, they don't allow you to file additional information at a later stage. So it's very critical to make sure you work with an external advisor and the in-house team to provide all the information, all the reconciliations, all the explanation and information that is required to address the issues during the audit, so that in case the matter goes to higher stages, whether it's an objection, whether it goes to the appellant bodies, you already have submitted all the key information that you can use to support your case as it goes up the dispute resolution processes. And another issue to consider is also we have to look at whether do we have to dispute everything? You know, do we have a strong position? Do we have strong documentation to support some of these issues? Because we should not just advise clients to dispute things for the sake of disputing. I know that is a fee for external counsels, but we need to add value to our clients. We can advise them to consider alternative dispute resolution mechanisms, like out-of-court mediation, where they can discuss, maybe they concede to some of the items that they think they have a weak position, and then they dispute some of the items. Maybe they can concede, pay the principal tax, buy installment, and request for remission and waiver of the penalties and the interest. That's also something that we should consider as we go through the dispute resolution. And proper documentation is very important. And when you talk of documentation, we should not look at only the statute of limitation period, that is 5 years where you can be audited, or 3 years depending on your jurisdiction. We should look at even proper archiving, because sometimes the Revenue Authority may conduct a tax investigation, which can go even up to 10 years. So you can't say this information is too old. No, that's not the reason that will be accepted. So even archiving should be done properly in a manner that if an information is required, someone can go and look at the archive. Even a 10 years old documentation can be found because it is in order, and it's also good to archive in electronically and in hard copies, because you may get a fire accident and then you end up losing everything. So that's what I wanted to share as far as tax enforcement and landscape is concerned. I've skipped some of the things because they're already covered by Dr. Laila and Irene. Thank you.
Thank you, Joseph. We do appreciate your presentation touching strategic compliance and risk management. Compliance certainly a major aspect of tax law, as opposed to doing post-mortem when the situation has already become bad. It is much more advisable to do health checks, as Joseph submitted, such that you avoid potential liability arising from non-tax compliance. Thank you very much, Joseph. I wish to put across a few points. Number one, for all the presentations that have been made by our panelists, I am duly advised that the ELS Secretariat will be sharing the same with the members. So we shall have a benefit to still refer to these resources even post this session. And thank you very much, ELS, for that. And then number two, our time is fast running out. I request anyone that could be having a question to kindly post it in the chat. If you go on the lower part of your screens, you'll see an icon for chat. You can post your question there. And then it is preferred that you also indicate which particular panelist that question is directed to. So we would be happy if you can do that, and then we shall save time and the questions would be responded to. Thank you very much. Allow me bring in one last panelist. He came in a bit later and we didn't have the benefit of introducing him, but join me in welcoming Mr. Brian Otieno. He's a tax associate with Bowmans, Kenya, and this is his area. Drinks, sleeps and dreams about tax, and he is certainly a good addition to the panel. I would invite Brian to just take 5 minutes and strictly to carry on from where Joseph stopped on the part of tax planning. How do we structure transactions, most specifically cross-border transaction, transactions, and maybe more specifically, if it can even be digital aspects of these transactions. How do we structure them to ensure that, you know, we are compliant with all the relevant tax laws for the different countries? So Brian, I would invite you, if you can kindly take 5 minutes such that we reserve some minutes for the Q&A. Over to you.
Well, thank you very much for the welcome. And thank you for the introduction. As you've been told, my name is Brian Otieno, an associate in the Bowman's practice based in Kenya, specializing in tax advisory and tax dispute resolution. So just before I proceed, just probably confirm that you're able to hear me and able to see my screen.
Yeah, we confirm we're able to hear you, we're able to see your screen. No, we can see, but we can't see your screen.
Sorry, okay. Is it visible now?
Not as yet. Perfect now. Thank you.
All right. Yeah. So you've asked me to speak on tax optimization strategies, which I had considered, but the bigger part of my planning was on the dispute resolution process, which of course I will highlight. But let me just start from the tax planning strategies that I see most entities are employing, especially from a practical perspective. When it comes to cross-border transactions, first, of course, is, you know, anytime that a client wants to conduct a transaction and they want to ensure that they are compliant with tax laws in the respective jurisdictions, it would be important for you know, those particular clients to engage with professionals and experts like ourselves, who will then advise on clear tax positions that are set out in the law. And this, of course, requires that
Brian, are you having any challenges? The presentation appears to have been frozen. Okay, I see Brian has just exited. It appears he's having technical challenges on his end, but he was presenting on the aspect of tax planning. Part of that has already been covered in the previous discussions. We can just be taking that in the meantime. Do we have any questions at this juncture? We have a few minutes left, so I want to give an opportunity to the members of the audience that could be having questions arising from the presentations that have been made. Our panelists are still on call and they are happy to respond to our questions. Two options: you can raise your hand and then we interact. Alternatively, you can just post the question in the chat. In the chat. Okay.
Edwin, just for we have some questions in the Q&A segment. There's a question from an anonymous attendee. I don't know if you attended to this, but he was asking to what extent are revenue authorities prepared to store, safeguard, and efficiently manage all taxpayers' data over long periods of time. And there's another question coming from Pauline Kinyajui. She's asking, how can legal entity rationalization help cross-border structuring to be more efficient and control tax risk? Those are some of the questions we're getting in the Q&A. 6 of them were attended to, but these 3 remain unattended to.
Okay, thank you. Specifically from anonymous attendee on how revenue authorities are prepared to store, safeguard, and efficiently manage all taxpayers' data over long periods. Tony highlighted about this, but I will invite him again to respond specifically to this particular question.
Yeah, sorry, and also we have Brian back on call. Brian, please confirm you can hear us. And perhaps before we handle the questions, let Brian make his presentation, then we'll come back to the questions. Brian.
Perfect. Welcome back, Brian. Welcome back, Brian. You can pick it up from where you left.
Sorry. I'll be brief. So, as I was explaining, when it comes to structuring of deals, most of the times, advisors are able to authoritatively speak to the tax position by setting out what the law provides and advising on the various methods or the various structures to adopt to ensure that the deal is tax efficient and that what is being done is legal and tax efficient. But I was saying that a few times you may find yourself in situations where the deal probably touches on some provisions that are not specifically spelled out or clearly outlined in the laws of the respective countries. And in such scenarios, then it is important to apply for private rulings so that you get clearance and ensure that the deal proceeds on an angle that will not expose you to tax risks or audits from the revenue authorities. But in the event that sometimes the deals probably result in disputes and audits, for example, then it's always important to be ready. And that is why I had this slide here that was speaking to the issue of some of the practical guidance that we have been able to adopt to help clients to manage audits and disputes and transfer pricing and tax governance issues that we have seen increasingly. Some of them have been spoken about, especially when it comes to documentation. From a transfer pricing perspective, you are expected to have, a 3-tier documentation approach, which includes the local file, the master file, and the country-by-country report, which, of course, the last one, country-by-country report, of course, only applies to large MNEs that turn over 75 million euros. In Kenyan shillings, it's 95 billion Kenyan shillings. However, for small MNEs, you're just required to have the local file and the master file. Now, in the event of a dispute, then some of this documentation come in handy, and not just the transfer pricing documentation, but also the primary sources of information that you are relying on to provide support for your case. And as has been highlighted also, it is important to keep documentation even beyond the 5-year limitation period, because sometimes, you may have cases where your audit, you're subject to an investigation, especially audits are limited by law, but investigations are in cases where there are fraud or negligence in filing of returns and all that, then courts have authorized and made it possible that the authorities could still go beyond the 5-year limitation period. And that then means that much as the law and the Kenyan Tax Procedures Act requires you to keep documentation for 5 years, you may do good to keep documentation as long as possible so that you are well protected in the event of an audit or query from the revenue authorities. Another thing that I may want to highlight is, of course, timelines, because certain times, taxpayers may be receiving audits or communication from KRA querying their transactions, and they may probably delay in submitting their objections or appeals at various levels. And this also may expose you because from a Kenyan tax perspective, we have had cases where the court says tax timelines are strict. And now that they are strict, if you don't object or appeal within the timelines that are set out in law, then you become exposed to, a risk of having to pay the tax as though it is due, because you didn't have the opportunity to object to the particular tax assessment. And lastly, as I finalize, it's so important for us to ensure that, we submit to the legal requirement, especially when it comes to burden and standard of proof. In tax proceedings, it is the taxpayer who has or who bears the burden of proof in terms of providing the documentation and the information that is necessary to convince the revenue authority or the tribunal court that your position from a tax perspective is sound. So the revenue authority will issue an assessment, and in the assessment, they will set out their legal position and demand certain taxes. But then it becomes a responsibility to prove that the revenue authority is wrong and that you don't owe the taxes that they're demanding, or in the case where you agree, then that probably will be another discussion. So just to run through the dispute process from a Kenyan perspective briefly, as you can see from my screen, normally the process will start from a tax decision. And sometimes this may come after you have had informal engagements with the revenue authority, where they informally engage you and tell you, you have these taxes, we are intending to raise an audit, what is an assessment, and you may have, in certain cases, the opportunity to have a discussion and maybe settle it. But if it doesn't end at the point where you have a pre-assessment, then that is where the formal process of disputes resolution comes in. And this is where you will have a tax decision where you will object to within 30 days of the issue. And then after that, after filing your objection notice, then it goes to the Independent Review Objections Office, which then have 60 days to issue with a decision. And if the customs issue, then it's 30 days from the date where you file the objection. Subsequently, if the matter remains unsettled or unresolved, then you can then appeal to the Tax Appeals Tribunal within 30 days of the objection decision. And in that case, of course, you need to file the proper documentation. And of course, these ones are set out in law: statement of facts, memorandum of appeal. But of course, you must file the notice of appeal first within 30 days. And then you'll file the statement of facts and the memorandum of appeal within 14 days after filing the notice of appeal. And that is different when it comes to customs. So I just wanted to highlight those few things. I know time is fast spent, but I think from a cross-border transaction perspective, I think it is important for us to, ensure that we are compliant. And that then means that we need to always ensure that we check with our advisors and consultants to give us the correct positions. And in the event that it is possible or it is necessary to speak to the revenue authorities for clarifications, then you have the avenue to go through private rulings. And that also brings me to my final point, which I wanted to highlight on some of the developments you've seen in the transfer pricing perspective. Quite a number of audits, but we have also seen efforts by the revenue authority, especially in Kenya, to try and keep pace with the developments. Now we have the draft transfer price, advanced pricing arrangement regulations that are seeking to, set out, the model of implementing, the recent amendments to our tax acts to allow taxpayers to enter into an arrangement with the revenue authority that decides or determines the method of transfer pricing, so that, we avoid some of the cases where KRA comes and disputes your transfer pricing documentation and slaps you with an assessment that is quite, or sometimes is quite huge or humongous. But even as we are doing that, it is important also to highlight that the regulations are still open. We have not yet seen their enactment. It then means that taxpayers still have the opportunity to engage and try and give views, on some of these things. In a forum like this, it will be necessary to sensitize and ask that, we should be able to speak about these things, because one of the things I've seen, which I have heard from other fora being highlighted, is that, the regulations provide for, an application fee of about 5 million Kenya shillings, which some taxpayers feel like is quite on the higher side. And this probably could be an opportunity where we get to discuss some of these things so that the Revenue Authority considers in the final version of the regulations that will be enacted. So thank you very much. I know time is far spent. I will not proceed beyond this point. Thank you.
Okay, thank you very much, Brian Otieno, for the good presentation, notwithstanding the technical glitches that happened earlier. And I also want to thank everybody that has attended this call. We had indicated earlier that we would end this presentation at exactly 4 p.m. Allow me seek an extension to end at 4:10, 10 minutes past 4 East African time. We had some questions. Some of them had been attended to in our chat or Q&A. I understand Brian and Laila did a good job in responding to quite a number of questions, but there are just two that I want to put to our panelists to resolve or address, and then we shall move on to the next part of the program. Specifically, I think this should go to Tony Kalunji from the perspective of a tax administrator. And someone is asking to what extent are revenue authorities prepared to store safeguard periods. Tony, if you can,
Thank you, Edwin.
Take 1.5 minutes to respond to that. There is another question that I will put on, and then as we look to conclude.
Yes, Edwin. So briefly, the law is there. At least the law was put that mandates us to respect and protect information. So if we do not do that, there are repercussions for that. But then also mechanisms and practices show. I think for now we have not had any case. We have not had a case where we have probably done that or breached it. So the systems are there. If we go into the IT department, the constant monitoring and protecting and the way even we store the record is designed in such a way that even me, Tony, who works in the authority, if I am to view the tax affairs of Edwin, there's a process I go through, which will probably leave a trail. So we are designed to do that. But I think we'll try to improve, if at all there's room for improvement. There are talks of trying to obtain space on some servers and try to bring them home. But in the grand scheme of things, we are prepared. Just the nitty-gritties and how we keep doing it. So basically, even if we have gone digital, there is a backup for this information in a manual way, and we have records where we store the same. So but even if we fail, there are safeguards to bring us back to book and to see that we would do that. So briefly, that's it.
Okay, thank you very much. I get from your submission that our data as the taxpayers is safe with the tax authorities. I would like to believe that that is the position. Well, we have one more question from the Q&A. I will direct this to Dr. Laila. If you could also take just 1.5 minutes to respond to it, and then we can also see how to call this to an end. This is from Pauline, and she is asking, how can legal entity rationalization help cross-border structuring to be more efficient and control tax risk? Dr. Laila, if you could take a moment to just respond to Pauline.
Thank you. So if I can break down Pauline's question in the context of taxing the digital economy, it's about how legal entity rationalization. So if we look at this legal entity, we're going to refer to it as either a incorporated or an unincorporated digital platform that is providing digital services to users in like multiple market jurisdictions. And in the context, it's East Africa. So then if that is the background, and then how does that legal entity rationalization help cross-border structuring to be more efficient? Now, this is where you draw in the East African community. Number one, how is because the East African community already has a customs union, it's already got some harmonized and ratified rules that are applicable to, customs. and also excise duties and some of the import duties. We've seen rationalization in that context. But now if we're going to be talking about the EAC perspective on how digital platforms are rationalized in terms of cross-border services that are taking place across our jurisdiction. So say if we come up with our own framing of OpenAI, and it's a Kenyan based. And now it's also providing services to Ugandans, Rwandans, Burundians, Tanzanians, right? We do not have an East African protocol that regulates that digital economy space. So the rationalization to help cross-border structuring actually fails because of the lack of protocol. And that protocol has to first emanate from the from the national perspective. We have to have some sort of a national policy as well as a legal framework that helps us understand how we are supposed to tax some of these digital platforms. So we've already seen that we're beginning to take unilateral measures in imposing DST and VAT, but these are specific to national jurisdiction. How do we rationalize this across the East Africa community? Now, to answer that, we also have to look at the broader perspective of the Africa Continental Free Trade Area and the approach that it's going to take in the context of creating policy that's going to be looking at a coordinated, harmonized approach to taxing the digital economy for the African continent. But if we cannot even agree on the rules of origin, which can be applicable to digital platforms as well, and then you look at the context of the WTO that has declared a moratorium on electronic commerce, then we actually have a legal gap and a lacuna and a problematic area when we think about this legal entity rationalization. So cross-border structuring cannot really prove to be a good utility if we do not have national legislation and legal framework and regulatory capacity at the domestic level to then take it from the East Africa community level. And that therefore means in terms of efficiency in taxing the digital economy, that efficiency has gone down to a low impact indicator. But what can we do is that, for example, Kenya is part of the OECD BEPS project. I think Tanzania is not, right? So then that creates a bit of a limbo whereby we're beginning to say that we need to have some of these digital corporations agree to country by country reporting, and the revenue authorities need to start also implementing common reporting standards. Maybe that would be the best way forward from a global perspective to implement the BEPS project at the national level to bring about that efficiency. And that would be one way in which we do end up controlling the tax risk. That would be my short intervention.
All right, that was spot on, Dr. Laila. Thank you very much for the response. We've come to the end of our session today, but if anything else fails, at least let this be the point that you pick, that the digital taxation is no longer a future conversation. It's no longer something that we talk about that is going to happen in the near future. It is now, and it comes with challenges, it comes with opportunities, but also for the different players that are involved, that is the economies, the professionals, and the tax authorities. There are lessons, there are opportunities, but there are also challenges. Thank you very much, and most especially to our beloved audience, we sincerely thank you for taking your time to attend this session. To me personally, it has been very enriching as a tax practitioner in Uganda. There are quite a number of lessons that I have taken from this session and which I look forward to incorporating in my practice. I want to hand this back to the Secretariat to close the session. And if there are any other administrative issues to be addressed, I would invite Mr. Gabriel Achaye to come in. Thank you very much and good evening.
Yeah, thank you so much, Edwin Mugumya, our esteemed moderator, for leading us through a very lively and interactive session. I feel you've done exceedingly very well. So thank you so much. To you, our esteemed panelists, we cannot thank you enough. Words cannot express how grateful we are to each and every one of you, Dr. Laila, Mr. Tony Kalunji, Mr. Joseph Waziri, Mr. Brian Otieno, and of course, Ms. Vanessa, who have all been on this call. But most importantly, for taking out time and do in-depth research and give us a one-in-a-lifetime delivery of these various topics. Thank you so much. We are really grateful for taking time and giving us these exceptional presentations. Now, I've seen a comment that majority of the members are requesting for these presentations, and some have said they've not been receiving the same, so we'll ensure this time around, while communicating via comms, that we have these presentations actually shared, because you can keep them for reference and for posterity. So I'd like to thank our panelists for that generosity. This afternoon, the message has really been clear for us who have attended this webinar. And the message is, as a region, East Africa is no longer waiting for the world to fix digital taxation. We should actually be rewriting these rules ourselves. And over the next couple of months, under the Tax Law Committee, we'll be trying to pick up this conversation from this webinar session to actually have practical engagements with some of the stakeholders on how we can actually achieve this. So we'd like to once again thank you all, and thank you our participants for always showing up in very large numbers and for supporting us. Now, in terms of announcement, I do have a special announcement to make. As you may all know, our bespoke East Africa Law Society AI Masterclass was reviewed and date shifted to 7th and the 8th of May 2026, and that training will be happening on those dates. The session was slated to happen on the 26th and 27th of March, which is today and tomorrow, but we rescheduled it to ensure that we deliver a very wonderful masterclass. So if you have not yet registered for the masterclass, we highly encourage you to register for this masterclass. For those of you who have already registered, thank you for that registration. And this session will be happening at the Fairview Hotel in Upper Hill in Nairobi, Kenya, on the 7th and 8th of May. For more information, please reach out to us at East Africa Law Society. If you're not following our social media handles, follow us at elawsociety.org or write to us at info@elawsociety.org. So with that said, we'd like to thank you all. Have yourselves a very lovely afternoon and a very lovely week ahead until we meet again next week. Wishing you all the very best. Goodbye from us, and stay blessed. Thank you.
Thank you very much. Goodbye.
Thank you very much. Goodbye.